All right, so we're back talking about chapter 21 in managerial accounting. So this is the second video where we are focused on our standard cost when we're talking about budgeting. The first video was focused on fixed versus flexible budgeting. So this part is fairly tricky, but hopefully you'll understand it as we go through it, and then especially when you start working on the assignments. But always feel free to reach out to me as your instructor, and I'm happy to help. Okay, so standard cost. These are preset amounts that we believe a product or service should cost in normal conditions. So you would look back at the history of how much maybe wood cost or plastic cost, or maybe the tires for a bicycle cost. You would look back at the history and you would have a standard cost of what you expect it to continue to be. So we use this in flexible budgeting, just like we did in the first video for this chapter, and that helps us to understand why there's a variance. So remember, in the flexible budgeting, we saw there might be a favorable or unfavorable variance, but why is that? And I said, as a manager, you'd have to dig into it deeper. Well, standard costing helps you to see why the variance is there. So that part's important. So we have preset costs for delivering a product or service under the normal conditions, as I mentioned before. And this is going to be established by the people who are dealing with these costs on a regular basis, the personnel, engineering, and accounting. They're going to look at the past experiences. So look at the history of it. We're going to base it on the expected level of performance, and we're going to use those costs for direct materials, direct labor, and even overhead. Okay, so setting these costs. So we have our price standards and then our quantity standards for direct material. Well, let me go back and let me just talk about direct materials first. So when it comes to direct materials, so let's say that it is tires for a bicycle. Our price standards, I have no idea how much tires for a bicycle cost, but let's say they cost $20 a piece. That would be the standard price. We say, okay, it costs $20 per tire. The quantity, we expect a bicycle to have 2 tires, so that would be 2 tires times $20. We would expect to spend $40 would be our standard cost for a bicycle. Now, when we look at actuals, that could vary. Maybe the price went up to $22 a tire. Or maybe we went through 3 tires because we have a lot of new personnel, and almost every bicycle that they are assembling, they pop one of the tires. So we end up using 3 tires for every bicycle. How ridiculous is that? So here's our standards, the $20 per tire, and the fact that we need 2 tires per bicycle, but the actuals may vary from that. Then direct labor. We have our rate standards. So let's say we typically pay our employees $18 an hour. That is on average what they get paid. And we expect to be able to assemble a bicycle in 30 minutes. So it would be $18 an hour, and we'd be able to do 2 bicycles. It only takes half an hour to create or to assemble a bicycle. So that would be like $9 in direct labor per bicycle. Okay, so $18 an hour. You can create one in half an hour, so that'd be $9. That's our standard. That's what we expect. But maybe we end up using, again, newer employees that they're only getting paid $15 an hour. So our rate standard is going to vary from what we actually are paying the majority of the employees, so what our actuals are. But it actually takes them a full hour to do it because they're new. So our time standard is half an hour, but in actuality, it's taking them an hour each because we have all these new employees. So we see how those could vary. Our variable overhead, again, rate standards, we come up with that with our formula, that predetermined rate that we've discussed in prior chapters, and then we base it on whatever activity, whether it's direct labor or direct materials. So let's look at an example. This is Pro Bat Company, and they have their standards for direct materials, so the wood for a bat. They per unit need 1 kilogram, it's $25 per kilogram. So 1 kilogram times $25, and we expect each bat to cost us $25 in materials. Direct labor, it takes 2 hours, excuse me, it takes 2 hours to create this bat. And so maybe they have a lathe or something that they create this with, and they're paying their employees, their standard amount is $20 per hour. So $20 per hour times 2 hours, it's $40 in direct labor cost. And then overhead, we've got those 2 hours we're basing it off of, and we're going to say because of a predetermined rate, it's $10 per hour. So 2 hours times $10, $20 in overhead. So this is all our standard or our budgeted cost. This is what we expect based on the quantity and the cost. This is what we expect. So total, it would cost us $85 to create a bat. It's a lot more than I would expect to create a bat. But bats range a lot in prices. My softball career ended very early last year when we didn't have a wooden bat. We had a metal bat, and I took a softball right to the face, broke all my sunglasses, and slit my eyebrow open. Had to get that stitched up. I'm not very athletic. I'm not very coordinated. So you would not want to buy a bat that just the cost of creating it was $85 for me, because it would be a big waste. I do not hit enough baseballs or softballs to make it worth it. But we know that a lot of bats are that expensive. And so if the cost of this is $85, we would actually be selling it for hopefully, I don't know, 120 or something like that. So that's how we prepare the budget. Then we have the cost variance that we're going to look at. We're going to take the actual, this might be something you want to note. AQ is actual quantity. So how much wood did it actually take? How much wood could a woodchuck chuck? How much wood did it actually take to make a baseball bat? So we have actual quantity times actual price. So was it actually 1 kilogram? And it was, what did we say it was? $25 a kilogram, I think. Was it actually that price? Was it actually just 1 kilogram? And we compare that to those standards, the standard quantity times the standard price, and that tells us the difference. So let's see what that would look like. Well, first, yeah, let me point this out. We just talked about in the prior video, actual cost. Okay, if we're talking about a cost here, not sales, but a cost. If the actual cost is more than the standard or budgeted cost, then that is a U for unfavorable variance. We don't want our cost to be higher. If our actual cost is less than the standard cost, it would be favorable. Think about this as your grocery cost. If you actually spent more than you budgeted for, that is unfavorable. If you actually spent less than you budgeted for, that is favorable. So when it comes to cost, that's how we look at that. So here's where we get to the tricky part, and we're going to fill this in with numbers as we go. So we don't just want to know why or how much it varied in price that we spent on making these baseball bats. We want to know why. Was it because we had to use more wood or more direct materials, the quantity, or was it because the price was higher, or was it a little bit of both? So this whole diagram here will help to show us why did we overspend or underspend? Why was there a variance? So again, it's good to have notes on the AQ, AP, SQ, SP. So here you're just fill in one thing at a time. We take actual cost. So that actual quantity times actual price is what we actually spent on the direct materials. Then we compare that to the actual quantity times the standard price. So we take this amount here, the AQ times AP, minus AQ times SP, and the difference tells us the price difference. So regardless of what the quantity was, how much was the price difference? So this is just going to break it down by price. Over on the right side, we're going to break it down to the quantity difference. So we take these same amounts, AQ times SP, then we subtract out the standard cost, the standard quantity times standard price. That will tell us how much of the variance was because of the quantity difference than what we budgeted for. And then we put those together if it's two positives, so we have two two unfavorable amounts, then we have one big favorable amount. We'd add those together. If it was two negatives, we'd add them together and show our large unfavorable amount. Now, if we have one positive and one negative, we need to take the larger number minus the smaller number, and it will show whichever direction that it should go. Hopefully that's not too confusing. The main thing here is you just got to fill in the numbers, the actual quantity, actual price, actual quantity, standard price. And you just fill in each of those. So let's look at our situation here. We've got actual quantity and cost. We actually used 1,800 pounds of material. It was $21 per pound in this new example. So we spent $37,800 on our direct materials. But for budgeting purposes, our standard quantity, we thought we would use 1,750 pounds for however much we manufactured. And the cost we expected to be $20 per pound. So total, we thought we were going to spend $35,000. We spent $37,800. The difference is $2,800. The actual costs were more than the standard or the budgeted cost, so that's unfavorable. So now we need to figure out why. I mean, just looking at this, I can tell that, okay, we had more material, more quantity, and it cost more. But let's figure out exactly the difference. So we fill in the actual quantity, 1,800 pounds, and $21 for the actual price. So just like we saw on that graph, we spent $37,800. Then over here, we put the actual quantity, just like we did there, times the standard price. That gives us 36,000. So when we compare, if we would have used 1,800 pounds either way, but it would have been at the standard price of $20, then we would have spent 36,000. That means the price had an $1,800 unfavorable variance because the actuals were higher than the standard, than the budgeted. Then when we compare these same factors to the standard quantity and price, that's going to tell us that it has a $1,000 unfavorable quantity difference because we had to use more material than we planned. We spent an extra $1,000. That's even if it was only $20 like we had budgeted for. So when we add those together, we get the 2,800. But now we know that the majority of it, the 1,800, came from price variance, and then 1,000 of it came from the quantity variance. Told you this part's tricky. I know. Just maybe listen to it several times. The labor variance, we're going to do the same exact way. We thought it was actually going to take 3,500 hours. That's our standard, but it only took 3,400 hours. We thought we were going to spend $16 an hour for the employees, but we actually spent $16.50. Maybe minimum wage went up or something, and we decided to give everybody a raise. So we actually spent $56,100. We only planned to spend $56,000, so it's a $100 unfavorable variance. Who cares about $100 unfavorable variance? That's going to be immaterial for almost any company. But if we break it out in these standard costs and these hierarchy here, in this diagram, this will help us to see what made up that $100 variance. Was it just a simple $100, or was it really leaning in one direction that was causing this? So when we fill in all the numbers, the actual quantity, actual price, the actual quantity times standard price, and look at the difference, $1,700 of it was because of that additional 50 cents per hour for the employees. $1,700 unfavorable. So that actually makes a huge impact. But then remember, they didn't spend as many hours making it as we thought. So that balanced out that difference to being $1,600 favorable. Because they were more efficient than what we planned on, we saved $1,600. But then we spent an extra $1,700 because we raised the rate or because we used more expensive employees. So they net out to be only $100 unfavorable, which most companies, most people are going to look at and they'll be like, I'm not going to spend any time on that. But then you dig in like this and you're like, wow, that was a huge unfavorable variance when it came to the rate. It just was offset so much by the efficiency that I was just going to ignore it. And it barely looked like any difference at all. but this really helps to show where my variance is coming from. So last thing we'll look at here is the standard overhead rate. This one's pretty simple. So we have the determine allocation base, which you already know. We figured out if it was direct materials, direct labor, whatever we're basing that overhead rate off of. And then we figure out what is the predicted activity level for that base. And then we come up with a standard overhead rate. Y'all have done this over and over again. Total overhead costs at the predicted level, so that might be $200,000 for the company, divided by the total direct labor hours, if that's what our base is. And that gives us that standard or predetermined rate. Then we take the actual production times the standard amount of the allocation base times the standard rate, and that gives us how much we want to apply. So let's just fill that in here. If we produced 3,500 units and it was 1 direct labor hour per unit times $2 per direct labor hour, be $7,000. So hopefully that makes sense. Just wanted to cover direct labor, overhead really quickly because that one's not quite as challenging. This is what you've been doing the whole time. And then of course, you look at the standard compared to what you actually spent and then figure out what the variance is there. Hopefully these standard costs are making sense to you, but feel free to reach out if you have any questions.